Fair point, Ashwani. Thanks a lot for that. In fact, we'll thank all our experts on, for joining us on the market opening. Bharat Forge is your stock of the moment now in the F&O space, up 5%, and PI Industries, of course, in the cash market. We have Amish Shah now joining us, India equity strategist at Bank of America Securities. Amish, good morning. Thanks a lot for joining us. Your thoughts on this one-way rally that we have seen, not just for our markets but globally, and how should one participate in this now?
Sure. Good morning. Thanks for having me on the show as well. We've been positive on emerging markets in general, not just India. And if you look at India's valuation premium to the other emerging markets, and India has always traded at a premium, we are currently close to around 45% premium to other emerging markets. At the peak, this number has been up to around 73%, and the average is around 43. So I think we are still very close to the average, which basically means that there is still scope for further re-rating.
Okay. Well, Amish, good morning and good to have you with us. Actually, we have all been enriched by the recent note you have written on Make in India and the performance-linked incentives, the PLI schemes. Let me get to it because it's got stocks which we don't often get as buys. You think that there is a lot to go for stocks like L&T, Siemens, ABB? You think we will be able to attract a lot of construction? At the moment, we seem to be bankrupt on capex.
Sure, Latha. In the here and now, maybe obviously this is a tough year, given COVID, government tax revenues are down, capex is one of the discretionary spends. You may not see it immediately, but the point that you made around the production-linked incentives, we have currently seen progress only on the mobiles front. If this develops into more and more sectors, and it seems this time it will, because the government is very targetedly focusing on a few sectors where they want to attract FDI. So if it expands into more sectors, then I would definitely say that this could be the theme for the stocks that you mentioned.
Okay. Well, since you brought up the issue of electronics, your note also has names like Dixon in it. Now, we just got Dixon's numbers and they were obviously lower. It's a COVID hit quarter. But, these prices have also skyrocketed. Dixon, is trading at what, some 60 times or thereabouts FY22 earnings. Is this something that's already priced in?
So, Latha, meaning as you know that we unfortunately don't comment on stocks specifically.
If you can give the context.
Yeah, but let me give you a broader picture, yes. So, think of it like this, that India's share of manufacturing in GDP has been stuck at around 18% for the last several years. And, we've not been very successful so far in attracting FDI, but this time clearly looks different to us, and that's why we are more optimistic. So if you think about it, 4 or 5 things are working in favor, and government is really doing something more targeted, as I said earlier. And it's coming out in more ways than one. So, for instance, the production-linked incentive scheme that we spoke about for consumer electronics, similar scheme you have for pharma sector. The government has increased FDI for defense sector. They are breaking monopolies. So they are allowing global companies, private companies to come in the old monopolies of railways, on coal, on gas, in defense. So clearly these things are opening up. And then, you can clearly see that the government is trying to fast track some long pending reforms in India. We've already seen announcements within agriculture. We've seen some bit in defense. That there is plan to reform the labor markets, the power sector. So clearly these things do have a ripple effect. And even more that the government is right now trying to do on an immediate basis is to cut its fiscal deficit, the trade deficit with China, which is currently at around $51 billion. And this is coming at a time when the global companies are really looking as an option to diversify out of China. We had recently done a survey of all the companies that we cover globally. And the findings from this survey from the global companies is actually quite positive about reshoring or relocating supply chains, and within that India finds its place favorably as well.
Okay, Amish, hi, good morning. Just to take that Make in India theme forward a bit more, you do mention in your note that the Make in India program aims to increase the share of manufacturing to GDP, which is stuck at 17 to 18%. And this will really benefit a lot of the industrial companies, whether it's an L&T, ABB, Siemens. But in this industrial, capital goods space, we've seen that many of these companies have frustrated investors for a long time. There's been execution issues, not a great pickup as far as order book is concerned, and stocks have not performed as well. Will you still keep the faith here?
So on the back of all that you said, I would say that the valuations now have come down quite substantially. So for the sector, on an average, I would say that the sector is now trading at a valuation at -1 standard deviation. Markets are over 1 plus standard deviation. So clearly there's a valuation disconnect. What you don't have right now, you're right, is earnings visibility, and that's why the stocks are at the value that they are. But if you're a really long-term investor, and if you really don't mind having to wait for the earnings visibility over time, at these valuations, I think absolutely the sector does make sense.
Okay, no auto sector in this list. I mean, what's your view on the sector itself, Amish? Because we have seen some kind of comeback, though the jury is out on whether the worst is over or not. But your thoughts on this big sector, which has of course implications for the economy and the market as well.
Sure. So there are certain parts of autos that we are positive, and more particularly within the two-wheeler space, and that is mostly on the fact that we like everything that's happening in the rural India a lot at this point in time. Two-wheelers are more linked to the rural India. On the four-wheeler side, we are not that upbeat at this point in time. That is discretionary capex. Even from an individual's perspective, when the income levels are not that great, the retail credit growth from banks is coming off, savings, incomes, everything is going to get hurt. And especially at the valuations that these things are trading at this point in time, we think that there will be better entry points over time. One thing that I would probably say is that within the four-wheeler space, FY22 volumes that we are tracking are most likely to be going to be below FY19. So if you're going to have a 3 years of volume miss or a flattish volume, we are of the view that it is going to be difficult to sustain the valuations at the moment.
Okay. Amish, I wanted to ask you about consumer goods. They have obviously benefited during lockdown, and because we are ahead of the monetary policy, I'll put that angle in as well. We are probably going to see high inflation this year. That will help EPS. And there is more formalization, no taking away. Informal sector is decimated, so the formal sector is getting more markets. But at some point in time, we have to pay back debt, and so taxes or in some form, the money will be taken out of all our pockets. I mean, how do you model consumer goods? Today, Tata Consumer came with very good numbers, but they're all very high in valuations.
So, Latha, I would say that, over and above the factors that you mentioned about consolidation and volume growth having come in fine, also add to the fact that all of these companies are also meaningfully cutting costs. And some of these costs may be transitory, but some of these cost cuts may sustain. And if they do, even currently on lower volumes or lower top line growth, they're actually delivering you the earnings growth. So think of a scenario where the volumes come back and the costs continue to remain low. Actually, you're going to be upgrading your earnings. And if that comes through, then valuations being expensive, especially in a lower cost of capital environment right now that we are in, is not going to be a sole factor that will lead to these stocks correcting. In fact, we are arguing that these stocks will continue to do better.
Okay, one final question then from my end. Continuing with this theme of some of the economy-facing sectors, I wanted your thoughts on cement. There's been so far a good pickup, but do you think that could be dampened because of the lockdown, the sporadic lockdowns that we've seen across many states?
So Sonia, same thing as industrials. In the here and now for FY21, visibility for earnings obviously is quite weak. You have migrant labor challenges which has improved, but it is still a challenge versus where we were in the last year. Obviously, you have capex cuts, real estate cycle is not doing that great at this point in time, and all of this does impact the demand for cement. Prices have held up, but at the same time, demand is going to be an issue. So near term, yes, challenging like industrials, but coming back to the Make in India, coming back to earlier on your show, we have spoken about formalization of jobs that can help government cut down on subsidy bill. If all of that happens, I would argue that that money can have an opportunity to get funneled into capex later on. So again, from a long-term perspective, we are bullish. FY21 for near-term investors is going to be challenging.
Okay. Well, a final quick question, it's a template question almost. Are you comfortable with valuations and Sensex levels or Nifty levels given earnings growth trajectory?
Sure, Latha. So as I said, that for the markets broadly, overall, we are constructive and positive. And as I said, that valuations for India in comparison to emerging markets are still at average. And there is a scope for re-rating further. The valuations have been higher in the past. But then specifically talking about discretionary, etc., those are some of the sectors where we are not so upbeat. So it's going to be more stock specific and theme specific. Maybe it's not going to be a very broad-based rally across all stocks and sectors. But overall for the markets, we are constructive.
Okay, on that optimistic note, Amish, always a pleasure speaking with you. Thanks a lot for joining in and giving us details on that very interesting note on how you can capitalize on the Make in India theme and the new PLI incentive, performance-linked incentive that the government has given out. But let's do one thing. Let's focus now on the other story of the day, the emerging market space. We just heard from a guest a while back that emerging markets continues to be the theme and they expect money to move from developed to emerging markets for the rest of the year. We have James Sullivan, the Managing Director, Asia Equity Research at JP Morgan, who joins in now to give us his view on emerging markets and on India. James, good morning and thanks for being with us on the show. First, I wanted your thoughts on India because so far there's been a massive run that we've seen in Indian equities, and now the number of cases are sort of petering off, especially in urban cities. There's an theme that's playing out too. Do you like India right now, and would you put more money to work here?
So as a house, we are actually underweight India right now. And let me explain some of the underlying rationale behind that call on the market. Number one, as we track activity in India, we have over 300 data sets that we look at to put together a high frequency activity index. For India, that index does remain in contractionary territory despite some of the openings that you had referenced. This is the fifth week that index has remained in contractionary territory, which doesn't bode well for short-term economic activity. From a longer-term perspective, we really think the most critical thing for investors to be focused on is this concept of lost growth. One of the biggest things that we saw as an impact from the global financial crisis in 2008 was a change in the growth rate of the global economy and a downshifting of the global economy. We're seeing the same type of impact off the COVID crisis. On a global basis, JP Morgan is forecasting 4 percentage points of lost growth at the end of 2021. So this is not just a short-term conversation. So again, the global number is 4%. The lost growth for a market like China would be only 70 basis points. For India, that number is 9.8%. And so we do see a significantly shallower slope of growth for the Indian economy moving forward, which makes the valuations that we're looking at in the market somewhat challenging.